You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
All right, guys, it is my honor to introduce my guest for today's show, co-founder and CIO of Aspen Funds, James Maffuccio. James, how you doing today?
Doing great, Kevin. How are you?
Doing fantastic. Thank you for joining me here today. I know that you're a super busy man, so appreciate you taking the time out of your day to join us and hopefully tell us a lot more about your company, Aspen Funds. But before we dive into the meat and potatoes of the company and what it is you do, Jim, maybe take a few minutes for those folks that aren't familiar with you and your background. Tell us a little bit more about yourself.
All right. Yeah, there's probably quite a few folks out there that aren't familiar with me and my background. So,
well, let them have it.
First of all, I have lived with my wonderful wife, Joy, of going on. It's going to be 36 years here in a month. So I think it's going to work.
Congratulations. That's a good long run.
Yes, sir. Got at least that many ahead, I hope. So, and have five children, but they're not children anymore. They're all grown and officially launched. And we have three sons and two daughters that we adopted, two Russian girls that are now 23 and 25. And the oldest one has 3 kids of her own. So
wow,
we're multiplying. And so my wife and I moved out here to Colorado. We're up in the mountains in Monument, Colorado about 2.5 years ago. And we're empty nesters, and I'm kind of running the business remotely, virtually. So anyway, in 1980, I started into the workforce as an engineer, working for a large corporation, and did project management for them. And about 1985, I said, I've kind of had enough of the corporate thing. And so I took my project management skills and jumped into real estate as a small residential developer in Southern California. And really went through the ups and downs with an emphasis on the downs for the next, 20 years or so. And actually landed in this mortgage note space, and I kind of made the decision to retool and aim my focus at this in 2011, and then Aspen Funds was started in 2012, and really kind of born out of the adversity and the lessons that I learned of what debt can do to you if you're a small developer in a big lake, small fish in a big pond, and so that's what launched me into the mortgage space, is really my own experience having been on the other side of the debt equation.
Mm-hmm. Okay, fantastic. What did that start look like? So you mentioned you started Aspen in 2011. I think you guys launched your very first fund in 2014. So you had a 3-year gap there where I'm assuming you were really getting things established, building that foundation, not necessarily learning the ropes because you already had a good deal of experience coming into it. But give us an idea of what that foundation looked like as you laid it.
Sure. That's great. Yeah. So anyway, I had a little bit of a divine inspiration actually to move into this, look at this side of life, of the real estate industry to begin with. Having lost everything for the second time after the mortgage crisis, I found myself in 2009, 2010 doing anything I could to make a living in real estate. So I was doing some fix and flips like everybody else, and trying to do some wholesaling. And I got this picture, and I won't go into all the details of how this message came to me, but what I saw was this, that the wall that had opposed me and taken me down twice, to look again at it, and there's a door in it, go through to the other side of it, and that which took me down would be that which would be my recovery. And I don't want to get too ethereal on everybody here. I'd love to talk about that end of it. But I knew right away what that meant was you're on the wrong side of the debt equation. You need to be the lender, not the borrower. So I started going to conferences and learning a little bit about this, buying mortgage debt, taking the bank's position. So in 2010, I went to my first conference, absorbed a lot of information. 2011, I started applying it just myself. I raised a little bit of money from personal investors. And the niche that I discovered was the niche within the niche was actually junior liens or second mortgages, where the first mortgage was performing. I saw the wisdom in it once I saw the model laid out. And so that's where I focused. And it was 2012. My next step was, okay, I proved to myself and my handful of investors that this thing works, and this is a really rich gold vein. So my next step was to go raise a bunch of money from people that some of whom I'd lost their money. So it was a little bit of a daunting next step ahead of me. So really, literally starting over from zero at age 55 at that point in time. But I bumped into, I should say, it was another one of these divine appointments, but my business partner, Bob Frazier, who I knew who he was through a ministry, he contacted me, and we were kind of strangers. We knew each other's name. And he asked me, what is it that you do? And I explained this junior lien, this non-performing junior lien play to him. And he said, well, hey, why don't I join you? He's built really large businesses in the past, and he's really a scale guy. He knows how to scale a business. So he says, why don't I raise the money and do all of the financial and the investor relations and all the soft end of the business, and you just go find and do deals. And at first it sounded like, well, this is my baby. I want to do it, and you know how we entrepreneurs are, sometimes we're our worst enemies. And finally the light came on, like, wait a second, I can go do the part that I enjoy the most and I'm the best at. And so anyway, in 2012, late 2012, we formed our company, Aspen Funds. And by 2013, we actually formed our first fund. And he raised $1.5 million for that. And we went and we bought pools of these second mortgages, defaulted second mortgages. And by 2014, we were making the money, and it was really, really sweet. We were making 2.5 to 3x multiples on our investors' money. And we decided, let's really go big with this thing. And the first thing we needed to do is get me out of the wheelhouse once again. So we hired a guy actually that I met at that first conference I went to, and he's a 29-year banking veteran, and he became our workout guy, where he would actually be the one to contact the borrowers, and we launched our second and third funds, and we scaled up from there. So we've been adding people. And at this point in time, we've got, I think we're right at 20 people, and we still use a lot of third-party vendors and servicers. So, I mean, all of these 20 positions are very key. But I've pretty much worked myself out of a job in a sense. I mean, I'm involved in sourcing the deals and finding the opportunities, but it's really kind of always been my dream to build a company where I could be kind of in a director role in it. And the real blessing of this is my partner, Bob, and myself have our sons working for us. So Bob's oldest son and my oldest son work for us. In fact, my oldest son started with me in the basement back in 2011. and my youngest son just joined us a week ago. So it is becoming a bit of not a family business, but it's really fun to have family involved. So
that's fantastic. I appreciate you giving us that background there. Now, speaking to the distressed note side of the business, that's only one segment of your business there at Aspen Funds. So why don't you speak to the other side of the equation and what that looks like as well?
Right. Perfect. Okay. Well, so we were buying these non-performing second mortgages and working them out and creating our main exit strategy was to get these things reperforming, which would mean get the borrowers into a payment structure they could afford. In a lot of cases, eliminate a lot of the principal. So we were creating this reperforming paper. We were eliminating a lot of debt for them, but we were creating value and selling those reperforming cash flowing loans. And then three things really motivated us to start the other end of our business. One was we were realizing these are great cash flows and they're well underwritten, and most of the people have already passed through their problems that created the default in the first place. So it just made sense. Secondly, it was a tax issue that's created when you rehab a note or modify a note. There's actually, I won't go into the details, but there's a taxable event that happens called phantom income, and in order to mitigate the effect of that, you have to sell and get rid of these reperforming loans. And so and then the third piece was there's a missionary friend of my partner's who had adopted all these orphans, and he had a sizable sum, and he was talking to my partner about, what do I do with this money? I need passive cash flow. And so all of these things kind of converged, and we said, we're going to launch our first income fund. And I think we did that in 2014 or 15. And then we realized this is really the long-term growth leg of the business, because we can always find cash flows. And I think we can always find passive investors that want their money managed well with the security of real estate, but not the headaches of real estate. And so we have a fund structure that's actually growing much larger now for the income side of our business.
So does that side of the business actually work hand in hand with the, I guess, with the restructuring side? I mean, so do you essentially, to avoid that phantom income, do you exit out of those restructured notes and have them purchased by this other side of your business, the other entity? Is that essentially, is that your built-in exit?
Yes, that's right, Kevin. We do purchase some of the loans from our workout operation or our non-performing mortgage side. We also sell those out to the open market. There is a growing number of people that are becoming aware of buying these residential mortgages, and there's other funds that we work with, other hedge funds that buy them from us. And then on our income side, we buy from several sources, one of them being our own workout operation, of course. That was kind of where we started, but now we buy from several sources, and we're always looking for new. We don't just buy the reperforming seconds. We buy seconds, firsts. The income side of our business, we also purchase from, there's a lot of entrepreneurs that are creating seller financing paper out there where maybe they bought foreclosures, and instead of retailing the house, they'll put a renter in it and make them a lease option on the property and then turn that into a mortgage. Well, we'll buy those mortgages as well. So there's a lot of ways to generate cash flow in this business.
Is it typically one-off transactions on the income side of your business? Are you buying, one note at a time, or are you buying these things in tranches for the most part?
Yes, both.
Okay.
So we do buy one-off notes, and we're every note. On the income side, we scrutinize. We do a pretty deep dive due diligence on every single note we buy, whether it's in a pool or whether it's a one-off. We have bought. In fact, we're just getting ready to close this week on about $1.6 million worth of mortgages, and that's I think that's in the range of I think that's like 120 mortgages. But every single one of those has been scrutinized, and some of those are, by the way, are one-off deals, and then a couple of them are larger pools. So we have the bandwidth now to analyze and do pretty deep due diligence on large pool purchases.
So I'm guessing the profile of your investor from the distress side of the business to the income side of the business, they're two very distinct profiles. Probably I'm going to make an assumption here, and you correct me if I'm wrong. On the distress side, obviously, slightly higher risk profile, seeking higher returns, whereas on the income side, lower risk profile, more of a coupon clipper type investor that wants very stable returns, and they're okay with I'm guessing probably lower single digit returns, but again, correct me if I'm wrong here. I'm always wrong, but in any event, really where I'm going with that question is the different type of investors that you're catering to. I'm guessing they're not one and the same. They're two different profiles.
Yeah, you absolutely nailed it. On the non-performing mortgage side, there's a risk factor built in, as well as there's a time factor built in, and it's not a liquid fund. I mean, you typically will raise a fixed amount of money. We just closed a fund, for instance, and it was an all accredited investors fund, and in that fund, I think we were right at $8.5 million. 6.5 of that was equity investors, and then we did bring a senior debt facility on for $2 million. But yeah, those investors are people that we don't need this money next Tuesday. We can't get it back out of the equation. They're probably going to start seeing their return 18 months to 3 years down the road. But the good news is it's, we've been making, our first fund, we generated I think it was in excess of or very near a 30% IRR for those investors. But, they're on the edge of their seat the whole time. So, and on the income side, it's more of a 8.5% preferred return plus 1% of the profit. We do split the profit. So, those investors have made very high, high single digit and even some in the low double digits. But that's in general the way it breaks out. We have, for a new fund that we just are launching now, on the non-performing mortgage side, we have introduced a preferred return component where cash flow type investors, or I should say not cash flow, but set, first money out at a lower rate of return, plus the equity piece on that. So I hope that's not too complicated. But.
No, that makes sense. I'm assuming these are mostly residential notes that we're speaking to, not commercial, correct?
That's correct. The funds that we have done so far, our operating agreements are, very much tie us into what we can do with those funds, and we've been focused on the residential space. We do have plans to expand. And in fact, we've really been on the non-performing side. We've been in the not only residential but specifically the junior lien market, because as long as we can find those guys, we're going to buy them, because we do really well with those. But we're going to be expanding. We're really morphing into as much as we are a distressed debt business sponsor, I should say, we're an alternative investments provider. So Aspen Funds will continue to grow and morph as we see. We feel like our core competency is spotting opportunities in the marketplace, and then wrapping a business model around that where we can, we can leverage our project management skills and our depth in the real estate world to make things happen.
Got it. As far as the junior liens are concerned, what kind of acquisition criteria are you guys looking at as far as like a combined? I'm assuming you're looking at from a perspective of multiple different things in the underwriting, but like a combined loan to value perspective. What's kind of the threshold that you guys are trying to stay within?
Yeah, well, at this point in time, we've learned, and we learned this quite a while ago. You can't be if you're going to buy one-offs, you can be picky about what you buy in terms of the equity profile of the deal that you're buying. At our scale, we have to be ready to pretty much buy everything from unsecured, meaning the second lien has already been foreclosed out, but we still have the ability to collect on an unsecured basis. A lot of people don't realize that, but it's just like it's just like credit card debt. Now, that's not what we go after. We don't like that, and we usually will resell some of that debt. But you have to buy it all when you're buying in the kind of pools that we are. But I'll tell you what our sweet spot loan is, and that way we can make some sense around it. So we'll buy a second mortgage where at least what we paid for the loan has some equity above it. So let's, for simple numbers, if the property's worth $200,000. And the first mortgage is $150,000, and then maybe the second mortgage that we're buying is a $70,000 note. That's what's owed. So that would bring that to $220,000. Well, we may buy that $70,000 mortgage for $15,000. So we look at what you're mentioning as a combined loan to value number. Well, obviously the combined loan to value in this case would be above 100%. But we look at our investment to value to loan. Investment to value ratio. So that would be our $15,000 that we paid for the loan plus the $150,000. That puts us at a $165,000 total capital stack. If the property is worth $200,000, we look at life like, well, we got that $35,000 of equity covering our investment. And those are pretty realistic numbers. We also look for and strongly prefer when the senior lien is current. We like to see that the homeowner is making the payment on the first. So now we know we've got a property that somebody's taken care of for the most part. They're living in it, and they're paying down the first mortgage. So our position's actually getting stronger as they continue to pay down that first mortgage.
Yeah.
So we're sitting in there behind that. It's almost like having an option on the equity of the property.
Yeah, and obviously they probably care about their credit as well if they're actually making a payment on that first. So surely a good sign. Do you get to see what the credit profile is of these borrowers when you're looking at these various tranches to purchase?
Yeah, absolutely. We're tied in with credit third-party vendors that provide that, and we had to be vetted for that. In the beginning, it's amazing. When I say beginning, in the mortgage crisis days, 2008 through 2010. It was the Wild West, and there was people doing all kinds of crazy stuff in our business. As in anything, margins shrink and regulations increase. Those are two things that kind of mitigate against profit. But the infrastructure grows in terms of the vendors, the intellectual property that comes into the space, and the help that you get and the support that you get. So we're pretty well tied in with that, and the model grows more sophisticated every year. But yeah, we look at credit. And a lot of other things that we track to get as granular as we can on our purchases. Got
it. And of the loans that you purchase, speaking to the junior liens, what percentage typically works out? I mean, to where like you were able to structure a successful workout, get that thing performing again, and then when do you basically jump ship on whatever's left over? Like, how long do you work it before you determine that it's a lost cause and you just move on as a loss?
Yeah, that's a boy. I hate to be elusive with answers, but that's actually
That's a
that's
tough
a
one.
moving target, because as we're scaling our business and raising more capital, we're becoming more velocity sensitive.
Got it.
So and because there's a lot of smaller investors in the space that are actually looking for one-off deals they can buy, we won't work alone as long. We'll try to get we'll try, if we can't wake the borrower up pretty immediately,
Hmm.
and it's not, and the metrics of the deal aren't such that we know at the end of the day we could pursue this thing all the way to the end and end up with the property with some equity. We will typically sell those to some of the smaller investors, and they turn around, in a lot of cases, they turn around and make a win out of it just by having the patience and the endurance. And they'll come back and say, hey, we've got this loan reperforming that you sold us a year and a half ago. Would you like to buy it back from us in your income fund? And we've actually done that. So they happen to catch the borrower at the right time, or maybe they're more magnetic to the borrower than we were. So
Sure.
it's kind of fun in that sense. But when we buy loans where there's plenty of equity above our investment, we have learned, we always put the olive branch out there first, but in a lot of cases, it's just these people in a lot of cases haven't made a payment in up to 10 years. And so when they hear from us, they challenge everything about what we're doing. And if we have to get the ball rolling with the foreclosure process without having the intention of actually completing the foreclosure. So back to your question, I would say we're about 65% of the time we are able to modify the loan, keep the loan, get it reperforming, and sell it to the income fund or another cash flow buyer. Another 10 or 15% of the time, we actually get a settlement, because we'll always offer a discounted settlement to the borrower. Mm-hmm. And it's amazing how borrowers can find money when their $100,000 mortgage they can pay off for $40,000 if they do it within 30 days. We've had people go to their 401k, borrow the money out of it, and boom, they liquidate us. And they're happy as can be because they just saved $60,000, but we just tripled our money for our investors. So it's kind of what I like to tell people that are in our space, that a lot of people do senior liens, the first mortgages. And with first mortgages, it's kind of a very clean logic tree, and I call it playing checkers. So dealing with first mortgages is like playing checkers. Dealing with second mortgages is like playing chess. There's a few more moving parts, some other dimensions that you have to consider. It's kind of fun. I love that kind of thing. But but I'd say 85% of the time we end up with an exit that's good for both parties, which is really, that's really fulfilling to us, because we honestly aren't in this thing just to make money. We're responsible to our investors. So of course that's our primary purpose, but we also enjoy the fact that we've kept a lot of people in their homes and with equity in their property, or a view to having equity in their property. That's pretty rewarding to us.
How have you seen the landscape change? I mean, 2014, obviously there were still a lot of distress notes flooding into the marketplace. It's kind of like a carryover from 2008, 2009 era. Obviously, things have dried up a little bit, I guess you could say. But I mean, just give me from your perspective of how that quantity has either increased or been reduced from 14 to today, as far as the amount of actual distressed or defaulted junior liens.
Right. Well, actually, going back to 2013 when we really started into this, so definitely the in general terms, it's kind of like people saying, how's the real estate market doing? Well, the coastal real estate market or the Midwest? So in general, we've seen the source, the quantity of deal flow has definitely diminished in the residential mortgage space in general. Most of that, again, remember, is first liens, and that's where most of the players have been. And margins have shrunk as price points have increased for mortgages in general. It's kind of interesting though, because in our space, in the second lien space, I really believe most of the defaulted second liens have still not seen the light of day, and the reason being because the institutions that originated this paper, they have to treat that debt differently. It's really consumer debt. And typically after 90 days, they'll charge that off. It doesn't mean it's not owed anymore, but it just means the institution has already taken its hit. So now it has this, bottom drawer full of, delinquent junior liens that a lot of them are just waking up and realizing they can sell and at least monetize them at some level. In a lot of other cases, some of the larger institutions, I think they're looking at the political risk and the publicity risk of, we've already taken the hit on this. Why would we put this out in the hands of some cowboy entrepreneur who's going to go threaten these borrowers, and it's going to come back to us. So we have been in the space long enough that we've got some name recognition. We actually were vetted by the FDIC kind of indirectly, and came out smelling like a rose because of the way we do our business. Because we've hired experienced banking professionals that know how to treat consumers right, and that's our workout operation. So for us, we've actually seen deal flow increase because we're getting into some bigger sources, and I think a lot of the smaller investors in the second lien space have kind of disappeared and gone on to other pursuits because it is harder to find them on the street level.
Got it. No, I appreciate that feedback. Now, speaking from a risk perspective, your business as a whole, if you were to take what it is you guys do, both components, you can kind of just blend it all together and look at it from a SWOT analysis standpoint. What are some of the biggest weaknesses or threats that you feel your business model has?
Okay, well, I'll do real quick on the non-performing side. I honestly, if I had a friend that was just getting into real estate today and say, hey, where should I stick the fork into this thing? I mean, this junior liens thing looks really exciting. I would say, you know what? I'm not just saying this to be greedy. I believe I have an abundance mentality, but I would say don't jump into those waters. They're shark infested. It's really hard to play at a mom and pop level. The regulations have grown. The barriers of entry have increased. There's licensing requirements. I would say if you want to play in that space and you've got the capital to do it, invest in somebody's funds or joint venture with somebody who does the work, has the workout operation in place. And again, I'm not saying this to be self-serving. We actually have, I'll just leave it at that. It's not a great place to jump in on a hands-on level unless you're going to go big and make the commitment up front that you're going to build the infrastructure. On the other side of the business, you can do anything from purchase a single note, and there's actually exchanges out there where you can Google this and find them, and we can help with some resources too. But for a passive investor, you can actually purchase these performing mortgages, and the risk side of it would be it's just like hard money lending. If you have $100,000 and you go out and buy one loan with that, and it's cash flowing, you look at the pay history, you look at the credit profile, I say, okay, this looks like a pretty safe bet. I have some equity covering my investment. But if that borrower stops paying, you all of a sudden have an interruption in that cash flow, and all of your eggs are in that one basket. So you need to be ready at that point in time to roll up your sleeves and go either foreclose on the property or get that borrower reperforming again. So that's the risk there, is an interruption of cash flow and the potential to lose some of your investment. The other side of it is you invest with a fund. And again, like ours or others that are out there, so that your investment is spread across, hundreds of loans that somebody else is managing. And for instance, we've built into our model that we can absorb, if 10% of our loans at any given time stop paying, all of the metrics of our fund are set up such that the fund investors don't miss a blip, and our management, we don't miss a blip. We have that built into our pricing model. So again, you're spreading your risk across a portfolio, which is nationwide, by the way. So we're starting to diminish our investment in the coastal areas and move more of our emphasis into the Southeast, Midwest to the degree that we can. We feel like those are safe plays. They're boring plays. We're not going to see huge appreciation in the property. We've already got some equity there. So, it's like anything in life, Kevin, you can mitigate the risk if you get smart about it and you drill deep into it.
Got it. I was going to ask you what markets you guys are in, but you just answered that question. So thank you for giving us that. As far as the funds themselves, the structures of your fund, I mean, would you classify them as blind pools, or do you typically have some pools of notes identified prior to going in and rolling out a new fund or doing a capital raise?
No, from the beginning, they've been blind pool. When I did my beta testing with smaller investors, those investors, including, by the way, my business partner, made a little investment with me first before he jumped into the business. And right away, he saw where it was going. He said, what the heck with this? I'm in, But back in those days, I would show the actual, here's the loans I'm looking at. Here's the ones I want to purchase. Are you in agreement since it's your money? And he'd say, yeah, and we would do it. But when we formed our first fund, it was like, look, you guys need to trust us. Those are the investors that took the biggest risk, the ones that jumped into our first non-performing fund. Now we've got a 7-year track record. So we're kind of a known quantity. We know our metrics really well. We do a lot of data analysis. We know what we're going to make on certain types of loans. We've been performing to that.
Got it. I'd love to switch gears real quick if we could. I know that you made a mention in the beginning of the show. You're based in Colorado, somewhere up in the mountains.
Yep.
I'm not sure where the headquarters are, but it sounds like maybe some or all the staff work remotely. Do you guys have a centralized office, or is everyone in a remote virtual manner?
Once again, yes to both. We have
Okay.
So our headquarters is in the Kansas City market. It's actually in Overland Park, Kansas. That's where our that's where my business partner, my two sons, his son, and our support staff, and we have a COO that we've brought on there. So that's really in a new workout manager that works out of that office. And then we have our office out in Maryland, where the Steve, the guy that I was first telling you about, that is just a brilliant guy, that he runs our whole workout operation and manages it. He's got a team of 7 out there now. And then there's myself and a couple other individuals who do work remotely. So we do a lot of face-to-face. We do this Zoom thing. We do Team Viewer. I fly back and forth to Kansas City at least once a month, and then we try to hit conferences and make that a point to get together. But it's been pretty. Hey, for a 62-year-old to be, co-running a virtual business, this is kind of fun for me. This is
No, it's awesome. I ask you that question because there's many folks out there that are, in the stages of building their company, and now with technology, you're able to be connected to folks across the country, right? You might find a business partner that's got that complementary skill set that you're seeking, right? That's going to help you take your business from where it's at today, to 3-4 levels higher. And
Right.
Ultimately, if you're not in the same area to where you can work out of a physical office together, a lot of people have a mental barrier as to how does that work, and how do we have the same productivity levels when we're not in the same room or not in the same building together. And so, and in fact, I'll admit it, even personally, I've had some of those challenges to overcome. When we've got a physical office, all of our folks majority of our team is working underneath one roof here in the office. However, we do have a few virtual folks, and we've actually continued to hire more. And so a year and a half ago, I was at the point to where I was like, we need a physical office. Let's hire everyone locally, just because I enjoy the dynamic and the energy that creates. And I feel like you lose some of that when it's all 100% virtual, right? I do feel like you definitely, you can do the Zoom, you can have everyone in the Google Hangout or Zoom meeting and see faces, but it's not the same as having like a physical energy presence in the same room together. However, I also think you limit yourself sometimes to potential talent when you say that I'm only going to hire within, the 15-mile radius that someone's willing to drive to work physically out of this office. In addition to that, you also limit talent to someone that maybe, for whatever reason, maybe it's when they pick their kids up from school, they literally can't work in an office till 5 o'clock, right? Because they've got a little bit of a blip in the middle of the day on their schedule where they've got to go take a child from, daycare to aftercare, and they need the flexibility to do that. And you might miss this rock star individual that they can't afford to be in an office. They don't have the luxury to do that, but yet they'd be a great addition to your team. And so, it's interesting because we've been having these conversations internally about, what does the future hold for our company? Is it something to where we work, virtually a couple days a week, and in the office the other couple days a week, and to where we don't lose productivity, but we give everyone a little bit more flexibility.
Absolutely.
Like when people are happy, when employees are happy, they're going to be more productive. They're going to go, to bat for the team even harder than they might have been before. And so anyway, I asked you that question more from a perspective of how do you guys manage it? What are some of the challenges you see having this, virtual / corporate type structure.
Right.
And, given the chance, would you structure it that way again? I guess is the
it's amazing because everything that you just said it's like a rundown of everything that we've had to work through, and we've got right on down to like some of our real rock star workout reps are on the East Coast, and they actually stay at home. They're actually part-time stay-at-home moms, and they were just great people. So I think the short answer to this is the number one resource is human beings. And we love the people that work for us. Every single one of them, they're fantastic people. We've only ever had to let go of one person ever. And, Steve, our guy on the East Coast, he has handpicked some of the people that he's worked with in the banking industry, and they happen to have small children. We said, hey, even starting with Steve, he expressed a willingness at some level when we asked him to join us, to move out to Kansas City, but he's lived in Maryland all of his life, and he has his boat there on the water. And we're like, look, we want this guy happy, and it comes down to trust, but you can only trust quality people. So you give people a good lifestyle, pay them well, and honor them, and let them go. So the people that are remote, I mean, that's what it comes down to. I mean, one guy that works for us, he's our acquisitions director, Tom. He's down in Austin, Texas now. Just moved there from Orange County, California. He hardly ever sees the rest of the team, but I mean, it's like this guy's a brother. I mean, we completely trust him, and he does a fantastic job. He carries the culture of our company with him, and it's really worked for us. It wouldn't work for everybody, especially if you don't get the right people. But I will be honest and say that there is definitely some of the dynamic that is lost that you mentioned. I like the energy of being around people. So sitting here in my home in Colorado, I get adult ADD. I got to get out and about. I'll fly out there and visit with somebody, and get together often. But there is a great dynamic in the office. You also lose, there's a lot of things where we have sometimes these round robin email threads. And it would just be so much easier. A lot of stuff rubs off, like in passing each other in the hallway, and you kind of figure out what each other's doing and how they do it. So there's a little bit of that, that it would be nicer if we'd all be in the same space. But all said and done, everybody's happy. It's working. It's not broke. I'm not going to fix it.
No, that's wonderful. I mean, what's funny, we use internally, not just internally, but to our external team as well. We use Slack for direct messaging, and the funny thing is, I'll find myself and the rest of the folks that are here underneath this, in the corporate office, will be slacking each other throughout the day. And I'm like, sometimes I just prefer to walk over to the next office and say, hey, I've got a quick question. I just want the answer to it. I don't want to have to get back on the Slack to get the answer. And a lot of times we're sitting here working virtual anyway, even though we're in the actual same office. And so it's kind of ironic, but I appreciate you giving me your feedback on that.
Plus, you probably have to step in and make sure they're actually not slacking, every now and then. No, I'm just kidding. No, none of your people would do that.
No, they're absolute rock stars. That's it. I think it's all about finding the right people, right? I mean, the right butts for the right seats that actually embrace that company culture that you have. And that's the important part. And, it's not even, I think that the right fit is much more relevant than the right skill set. Skills can be taught. However, the right cultural fit for the company and for your team, that can't be taught. I mean, you can get someone that's on a resume, they've got the skill set, they should be the right fit. However, personality wise, they're not a great fit. It's just not going to work out. And so I'd much rather have the personality traits and be able to teach them, get someone really smart, got the personality traits, teach them what they need to know versus the other way around. Ideally you get all the above, but
exactly.
Yeah. So, well, fantastic, Jim. This has been a lot of fun. Lots of golden nuggets that you've shared throughout the last hour or so here. And what I'd like to ask of you as we enter to what I call the golden nugget segment is, if you had just one final golden nugget left in your pocket, something of advice or wisdom that you could leave with our listeners today that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
Okay, that's so what I would say is this. First of all, I'm gonna start with the foundation that we're talking about. I'm gonna get granular within the real estate world, okay? Because I believe that's where, a majority of the wealth historically has been created. I know there's whole other fields, there's technology and this and that, but I'm gonna say within the real estate realm, for instance, person that's looking to jump in, like I want to get involved in this, I want to create some wealth. Spend the time to figure out what you want to do within it. And get a lot of counsel. And the abundance of counselors, plans succeed. So study it and figure out exactly what you want to pursue. And then once you make the decision, burn the bridges on everything else. Avoid the shiny object syndrome. Make sure that the model that you're going after is one that you've vetted it out completely in the beginning. Get the counsel from people that have been there, that have already been in it. And then once you jump in, laser focus on that thing. And from the beginning, think scalability. So don't over leverage. Don't misuse leverage. Build for the long haul. Be a little bit more patient. So maybe you're giving up on the equity. You're giving up a little bit more because you're bringing in equity partners instead of going and getting a loan from somebody. Because I'm telling you, debt will kill you in the long run if you don't manage it properly. But focus and drill that thing. Once you've made the decision, this is the focus I want. don't stop until that well hits pay dirt and it's flowing. Then if you want to go start something else, put the people in place to play that. But I think focus. Mm-hmm. And coming from somebody who's had a difficult time focusing until I got into it, my partners really helped me a lot with that. Man who chases two rabbits catches neither.
No, I love it. I mean, I preach it all the time. If you've listened to any of my other shows, I mean, that's probably one of the most common threads I share is absolute focus. I mean, we focus in the manufactured housing niche. That doesn't mean that's all we'll ever do. But it took us many, many years to master this business, and we do it quite well. And I'm sure at some point in time we might diversify and add something else into the realm of our business. But however, doing that in the first couple of years would have been catastrophic. If we were to literally, turned our focus and turned our direction and tried to split it into 2 or to 3, we surely wouldn't be where we're at today. So I wholeheartedly agree with you, my friend. Well, fantastic, Jim. This has been a lot of fun. Again, really appreciate you coming on the show. And folks, if you would like to learn more about Jim and his company, Aspen Funds, you can go visit him at aspenfunds.us. Again, that's aspenfunds.us. And so, Jim, that's all we have, my friend. Really appreciate you coming on here in the show. And folks, I appreciate you tuning in each and every week. And until we all meet again next week, this is your host, Kevin Bupp, wishing you huge success.